So I'm going to Okay. And then what I'll do is I'll go ahead and post the link to this afterwards so that you guys have it, so that, if you want to look it over, you can. Because today what we're going to do is start our review for your exam. So last class period for chapter 16, if we went through the hybrid asynchronous day, it actually wrapped up chapter 16, the material that you needed to know. Today, what we're going to do is practice quite a few problems associated with chapter 16 and some with 15 as well. But this will also help us get ready for our exam. So before we get going, I'm going to share my screen and take a quick look at the calendar, and then we'll go into the problems. So let me share this real quick and then pull up homework calendar. Everyone see my screen okay? We're good there? Okay, great. So here we are today on Wednesday. We are scheduled to do our review, getting us ready for our exam that's going to take place on Friday. If for some reason you're missing that exam due to traveling, for athletics, or for whatever might be going on, please make sure you get with me today so we can schedule a alternative for you to make sure we have the exam done for you. But the exam will take place on Friday this week. And so what we'll be doing is practicing some problems, both applying the chapter 16 content that we wrapped up on Monday, and then prepping you for your exam. Any questions there? And again, just as a heads up, since this is a little bit different format, just feel free if it's ever a question you have, or you want to chime in, just unmute, chime in. You don't need to raise your hand or anything like that. You can just chime in, or if you don't feel comfortable chiming in, just type in the chat. Okay, so that's what we have outlined for today. Let's go ahead and then get started with the material. One other quick note I wanted to make. Don't forget, since we wrapped up chapter 16 last class period, and I give you one more day because we had the change in schedule to digest the material, don't forget your chapter 16 homework is due tonight. Okay, so just remember that as well. Okay, so what we're going to do is I'm going to go into our Brightspace course, and we're going to go into the chapter 16 module. And then within the chapter 16 module, under the test two practice review problem, those are the problems we're going to be working today. So we're going to be working as many as we'll get time to do today. And I encourage you that if even if we don't finish them today, for you to work through them here. I've posted both the problems as well as the solutions for each one of these. Now keep in mind, for chapter 15, I've posted for you just one problem here with the solution, and then there's some multiple choice too. But one thing I want you to keep in mind is I would encourage you to practice this chapter 15 problem from both perspectives. You're only going to see one perspective on this problem, but I'd encourage you to practice the chapter 15 problem from both the lessee and the lessor perspective. And we'll do that today in class. So long as we get time, we'll do it from both perspectives. But I just want you to practice both because both will be on your exam. So keep in mind, even if there's one side that's posed to this problem, you need to practice both. The other thing is I don't know if you've already started practicing the problems or not, but keep in mind I've posted an additional chapter 16 problem just to give you practice on another topic as well. And so I'd encourage you, if you've already done the problems, to keep in mind there's an additional chapter 16 problem that's been posted, just as another topic that will show up in some way on your exam. Okay, any questions there? Okay, then let's go ahead and start first with the chapter 15 problem since it's the top of our list, and we're just going to kind of go down the line. Okay, so let me see if I've already got this one up. I do. So this is the problem. You're welcome to pull it up on your own. I'm going to give you a couple minutes to look at this and start working on this, and then we're going to work on it together. Okay, so take some time real quickly, start practicing it if you'd like. I'm going to give you a little bit of time here, and then we are going to start doing the problem together here in just a minute. Okay. Maybe reserve just a couple minutes here. Do just about one more minute and then we're going to look at it. Okay, let's go ahead and take a quick look. I'm going to get an Excel file started here for this so we can start typing out some journal entries. Okay. Sorry, it's a little bit challenging to navigate both the Zoom sort of uh, Zoom screen as well as this PDF and then also the Excel file now. Okay, so we'll call this chapter 15 problem. Okay, this says Eastern Edison Company leased equipment from High Tech Leasing on January 1st, 2018. They give us some information, say there's no expected residual value, prepare the appropriate journal entries for High Tech Leasing in 2018, 2019. You tell me real quickly, who is High Tech? Are they the lessor or the lessee? Just go ahead and unmute.
Lessor.
Yep, they're the lessor. So that's what we're going to start with. I'm going to put over here the lessor here. I'm going to do the other side here, lessee. Like I said, I encourage you to practice from both sides because both sides will be on your test. Okay, first thing we want to do is journal entry for January 1st. I don't know if they give us a year. Well, oh yeah, 2018. So we're going to start with 1/1/18. Maybe I'll move this over here. Okay, on January 1st, 18, what will be our first journal entry? What will we start with the lessor side?
Lease receivable and equipment.
Yep, absolutely. Lease receivable, and we're going to credit equipment. Now, we don't know the amounts yet. So what's the other potential that we might have here? Because I haven't done the calculation. Yeah, we're going to do it here in a second. But this type of journal entry for the lessor would be a what type of lease?
No profit.
Yeah, so this would be a situation where we have a sales type lease without profit. Now, if we did have profit, we would change it, right? What would be the additional accounts that we would use if we did have profit?
Debit cost of goods sold and credit sales revenue.
Exactly. So this would be our journal entry if we did have profit. Now, let's find out if we do or not, and then we'll get rid of the accounts. How would we find out if we do have profit or don't have profit?
Take the annual payments and multiply them by the present value of an ordinary annuity or annuity due, not ordinary.
Perfect. Yep, perfect. So this will be an annuity due, just like Xavier told us. We have this on January 1st, 2018, and the payments are due on January 1st each year. And so because of that, we know it's annuity due because it starts right away, right? So we're going to take this annuity due piece here, the present value of annuity due factor that we have here that they've already given us. And we're going to multiply that, like Xavier told us, by the annual payments here. So we're going to take this 80,000 and multiply it by 2.7833. Okay. And this amount gives us 222,664, which matches the cost of equipment. So, like Tori told us then, we do not have profit here because our amount of our equipment is equal to the lease receivable. So we'll make these equal like this, and we'll go ahead and eliminate that. And so now those are gone, and this will be our journal entry. Does that make sense? Any questions so far? Okay. On 1/1/18, we need another journal entry. What's our other journal entry?
The first payment.
Absolutely. First payment. So we'll debit cash And we're going to credit what?
Lease receivable.
Yep, lease receivable. And so the amount will be the amount of the annual payment here of 80,000. And so we'll set those equal to one another. And we will change those like that. Okay, let's go ahead and do the lessee side. We're not asked to do the lessee side, but let's go ahead and do the lessee side, right? Okay, so for the lessee side, what would be our journal entry on this side?
Right of use
Yep,
asset and then lease payable.
absolutely. Right of use asset and then credit our lease payable. Okay. And the amount will be the same amount that we had over here. It's the present value of the minimum lease payments. And that's what we've calculated right over here. So we will set those equal to one another. Now help me out with the first payment. What will be the journal entry there? And anyone?
Lease payable and cash.
Yep. Lease payable and then cash. Okay. And we're going to set those equal to the exact same amount here. Okay. Now, one other last consideration before we move on. Tori helped us out at the beginning knowing that this was going to be a sales type lease without profit. But remember, you have 5 criteria that you would go through to try to determine if it was a finance lease or a sales type lease versus an operating lease, right? So our 5 criteria, remember, we have transfer of ownership, doesn't tell us anything about that here. We have a bargain purchase, doesn't tell us anything about that here. We then have the majority of the economic life. Here we do have some information. Notice that the lease term is 3 years, and notice that the life of the asset is 3 years. So we're meeting the majority of that economic life. So here we already know that we have a finance slash sales type lease, depending on whether you're considering from the lessee versus lessor perspective. Then we'd have to just determine, since it was from the lessor's perspective, is what they asked us to do, whether or not we had profit or didn't have profit. But if we go on, we know that the next criteria would be that the present value of the minimum lease payments was substantially all of the fair value of the asset. And we know from that calculation that we did right here and compare that back to what the cost of the equipment is here, or the fair value of the equipment, then we know that that is the case here as well. So criteria 3 and 4 were met. We only need 1 in order for it to be a finance slash sales type lease, but we met 2 of those. The last criteria is the transfer of owner, or excuse me, the alternative use of the asset. And we don't have any information for that here. But regardless, we meet the criteria for a sales type lease because we met 2 out of those 5. Okay. Any questions before we move on? Okay. Then they wanted us to do the journal entries for 2018, 2019. You remind me, if they tell us we have a December 31st year end here, what would be the journal entry we would do at 12/31, 18, in order to capture an accrual counting concept for year end?
Accounts receivable.
Sorry, remind me one more time.
Is it accounts receivable?
It's close. It's not the accounts receivable for the lessor, but a different specific type of receivable. What specifically are they receiving?
Interest.
Interest. So we're going to have an interest receivable here and an interest revenue, right? Okay, so our calculation is what? We'll start with the original carrying value, right, of the receivable, and then do what?
Multiply that by the interest rate times
That's correct. But real quickly, what do we have to subtract first from the receivable?
First payment.
The first payment, because we have a reduction of the receivable, right? So the first thing we're going to do is do this. And then, Aiden, what will we do?
multiply it by the interest rate times the 1 year.
Yeah, times the time. But in this case, since it's an annual interest rate and the payments are annual, then we would just be multiplying 12/12, which means there won't be any adjustment there. So we could just leave it like that. And so our amount would be this 11,413 for our interest receivable. And we'll set this equal to this here. Everyone good with that? Okay, then matching it over to the lessee side, something very similar. Instead of interest receivable, what will we have? . I'm guessing someone's saying it, but you might be on mute. Interest payable, right? And then what will be instead of interest revenue, we'll have what?
Interest expense.
Interest expense. Perfect. And we'll go ahead and set these equal. Okay. Now it's going to be 1119, right? Let's move this down here. We got to give ourselves a little bit of space. There's one more piece that we probably need to do for the less E. They didn't ask us to do the less E, but since we're going to do the less E and the less or, there's one more piece that we probably need to do on 1231 that we don't have on the less or side. So before we move on to 1119, what is the last piece we need to do?
Amortization.
Amortization. So we're going to debit amortization expense and credit our right to use asset. Okay. And so for this, we'll just do a straight line because they don't give us information on that because they're not asking us to do the lessor. But we have a lease term and an economic life of the asset of 3 years. So we'll just go ahead and assume that it's going to be spread over these 3 years. So we'll divide this by 3. And this will be our amount of amortization. Any questions there? Okay, then let's go ahead and go on to 2019 now. Okay, what would be the journal entry we would want to do for 1119 for the lessor side? What are they receiving?
Interest.
Yeah, they're receiving their actual interest but in total, as part of that, they're receiving that cash payment, right? So they're receiving their total cash payment on 1119, and this amount that they're going to receive is this total of 80,000, right? Now, part of that is going to be interest, right? What do we have to get rid of here?
Interest receivable.
Absolutely. We got to get rid of the interest receivable that we booked previously, right? So we'll set this equal to this. And then what's the other portion? Because the journal entry isn't balancing yet. What's the other portion that we're going to have here?
Lease receivable.
Yep, lease receivable. So we're going to credit the lease receivable here. You guys are awesome. You're just nailing this. Okay, so we're going to do this and subtract the difference here. And that's going to be our reduction for lease receivable. Everyone feel okay with that? Let's go ahead and go on the less E side. What will be our journal entry here? Instead of receiving cash, we're doing what?
Lease payable.
Yeah, we're paying cash. We're going to reduce it. So we're giving up this 80,000, like we said. We're going to reduce our lease payable. And what else are we going to reduce? I think I see someone mouth
Interest
it.
payable.
Yep, interest payable. Perfect. Okay, so let's go ahead and set this equal here to the interest payable amount here. We know the cash amount is consistent. It's contractual. We have to pay 80,000 each time. And so the difference for the reduction of lease payable, right, is going to be the difference of these two here. Everyone feel okay with that? Okay, let's do one final journal entry on the less or side, and then we'll do 2 final journal entries on the less E side. All right, we're now, because they asked us to do all 2019, we're now at 12/31/19. And oops, I meant to say 19 here. And now we are going to do what? You remind me. What are we doing here?
Doing the accrual for interest receivable.
Absolutely. So we're going to take these same 2 accounts that we had previously and book those right there. Now let's go ahead and go with the calculation. And remember, we could have done an amortization table here, so that might have made things, just a little bit easier. But let's go ahead and go with the calculation that we're previously doing. I'm going to copy this real quick so that I can put it right back in. And then I need to subtract, though, something else from this. What else do I need to do to modify this calculation?
The payment we just did for lease receivable.
Yep, absolutely. So the 119 reduction of lease receivable, we need to also include here. And so we get that in terms of our calculation here, and we're going to set this equal. Make sure we didn't miss anything here. We had our original lease receivable minus the reduction times the 8%, and it's for a full year, so 12 over 12. Okay. And then let's go ahead and translate this to the less E side. We'll use the exact same accounts that we had previously. And because the calculations are the same, we are just going to set this equal to this right over here. Any questions there? Okay, we need one more journal entry for the less E side, don't we? What would be our final journal entry here?
The amortization.
Absolutely. So we're going to take this exact same amortization journal entry we had up here. And because it's straight line, we don't need to do the calculation again. We will just set it equal to one another. Okay, I'm going to pause. We've now done the less or and the lessee side. You will have solutions for the less or side posted to Brightspace. If you want to take a screenshot or something for the less E side, you absolutely can. This is how we would do the less E side too. I want you to be able to do both. Both will show up in some way, shape, or form on your exam, which is why we're practicing both today. Do I have any questions on this? Okay. Well, we'll go ahead and move on. I really was proud of how you all handled this problem. You guys nailed it. So I expect everyone should be, able to get a problem like this on the exam without too much of an issue. So great job. Let's go ahead and move on to chapter 16. Just to make sure though, no questions because I'm going to close this problem so I won't open it up again. Everyone okay? Cool. Okay, I'm closing this up. We're going to go on to the next problem. The next problem is going to move us into chapter 16. So this will help you in practicing some of the content that we just wrapped up on Monday. We'll just go ahead and go down the line. We'll start with chapter 16, problem 1 right here. So if you want to select on chapter 16, problem 1, that's the problem we're going to be looking at. Let me go ahead and pull it up, and I'm going to give you a little bit of time to work on it here. Sorry, I have test reviews for all my classes today, so I've got quite a lot of problems up here. Okay, this is chapter 16, problem 1. I'm going to give you all a little bit of time to work on this. It'll take like 3 minutes or so, 4 minutes maybe, and then we will look at it together. So go ahead and take a few minutes and try that. Just as a heads up, on your solution, it's going to show you how you might fill in a table because I know it says complete the following table below, but I don't give you a table. What I want you to do is focus on doing the calculation for taxable income and then focus on doing the journal entry, which will require us to sort of use an organized approach. And so you could craft that into a table or not. It's really up to you. But that's what I'm expecting is to kind of get the journal entry piece here. Okay, let's go ahead and try to look at this together and see how it's going. So they tell us at December 31st, 2018, temporary differences were associated with the following future taxable or deductible amounts. They give us that information, then they tell us no temporary differences existed at the beginning of 2018. Pre-tax accounting income was 80,000. Taxable income was 15,000 for the year ended December 31st, 2018. They then tell us the tax rate was 40%. What they want us to do is complete a table and prepare the appropriate journal entry to record income tax for 2018. Now, we don't have a table, but we're going to calculate sort of like a little format. And again, in the solution, I sort of give you a table so that you can see what that looks like. But here we're just going to kind of, go with a calculation on our own of how that table might look. But it'll be similar to what your solution looks like if you were to follow the table that you're given in a problem like this. Okay, I'm going to call this P1, first chapter 16 problem. Okay, so they give us a pre-tax accounting income of 80,000. So that's going to be where we're going to start. So first thing I'm going to do is say pre-tax accounting income. Remember, if you remember your 4 steps that we're doing here, right? First step is calculate, let's call it step 1. We'll say calculate taxes payable. That was our first step. We do that by calculating taxable income, right? So the first thing we're going to have to do is calculate what taxable income is. In this problem, they give it to us, but we're going to create a reconciliation for it. Step number 2 that we do, we have to calculate the ending balances for our deferred tax assets and deferred tax liabilities. Our third step is to calculate the adjustment to the DTAs and the DTLs. And then our fourth step is for us to plug our tax expense. And so that's our last step that we're going to do here. And so that would be the process that we would follow. And really that's what the table, if we want to call it that, what we're going to create is going to follow for us. That's really all we're doing is just sort of following these 4 steps that we learned in class. So our pre-tax accounting income starts with an amount of 80,000. That's what they tell us. So we're going to plug that amount in 80,000 here. Okay, then we are going to make adjustments. Now, they tell us that we have the following future taxable amounts and future deductible amounts. Now, think about the way they're wording this here. They're telling us future taxable amounts, meaning that we have to pay on these later. What does that sound like to you?
They're a deferred liability.
They're deferred tax liability. So the future taxable amounts are a DTL, and the future deductible amounts will be a DTA. Now, keep in mind, those that are taxable don't have brackets around them, meaning these two right here, the 60,000 and the 17,000, those represent the deferred tax liability. And this future deductible amount, that represents the deferred tax asset here. So in order to reconcile back to what taxable income is, because that's what we're trying to get here. In order to do that, we start with pre-tax accounting income, but our future deductible, or I should say, I'm going to start with taxable. Our future taxable amounts, we'll call this number 1, and future taxable amount number 2 right here. These amounts are going to be the 60,000 and the 17,000, but we're going to have to deduct those because remember what we said about DTLs. Deduct now, pay later. So the future taxable amount is where you pay later. So it's future taxable because we're deducting now. So the idea is we're going to have to deduct the 60,000 here, and we're going to have to deduct the 17,000, even though it doesn't show it in brackets here, because what they're saying is it's future taxable amounts, but for it to be taxable in the future, it must be deductible now. So we're deducting it right now. And then we're going to do the opposite with the future deductible amount. So here's a future deductible amount, the warranty expense here. And you could have known this if you just would have kind of thought through what these items represent, right? You would have known if it's a DTL or DTA because it represents examples that we've talked about of DTLs or DTAs. But that's the sort of rationale for why they're framing it the way that they are. So here we're going to add the future deductible amount because it's not deductible now, it's deductible in the future, is what we're saying. So we're going to add that 12,000 here. Okay. Everyone with me? Now we're going to sum this to get taxable income. So let's create a little space here and we'll say taxable income and we'll sum up this for us to figure out the amount we have. Now let's make sure that we've reconciled back to what they said taxable income was, which is 15,000, and it is. So now we've gotten to the taxable income piece. Now that is taking care of step number 1 for us to calculate taxes payable. Why? Because taxes payable is based on taxable income. So now to calculate taxes payable, we're going to start with taxable income. And then we'll multiply that by the tax rate, which they tell us is 40% here. Okay. So we'll multiply by 40%. And so we have taxes payable. Ugh, here we go. And so this is our amount of taxes payable. So let me get a little bit of formatting here, and then we should be good to go. Oops. Oh. Okay. Then I just like to do my calculations like that. Okay. Everyone good here? If we're doing a journal entry then, and I'm going to go ahead and start us out, right? Our journal entry will debit tax expense. We're going to credit taxes payable. I'm leaving a little bit of room because we're not sure what we're going to do with the DTLs or the DTAs yet. It depends on whether or not they're increasing or decreasing. The question becomes whether or not the DTLs or DTAs are reversing, so to speak. We'll find out here in just a second as we go through the calculation, but I'm leaving us a little space because I'm not sure what we're going to do with them yet. Okay. But the tax payable we've now got, that was step number 1. Step number 1 is done. Everyone good so far? Okay. Then we're going to continue on. So these will reverse in the future. So let me get a little bit of space here. I'm just going to do this one step down. Okay. And so we're going to say reversing amount. And I'm going to just change this to a negative of this. So this is going to reverse out at some point. They don't tell us the years that these are going to reverse out, but they do tell us they're going to reverse, right? So they say it's a future taxable amount versus deductible amount. They don't tell us the years, whether or not it's going to reverse equally or whatever it might be. But we don't need to know that to solve for this first journal entry. We just need to know that they're going to reverse, and we need to know the tax rate of what they're going to reverse. If they were going to have different tax rates each year, then we'd have to know the tax rate each year. But so long as it's the same tax rate, it doesn't really matter when it's going to reverse. We just know what's going to happen in the future. So what we will do to calculate our ending balances, I'm going to do 2 different columns here. I'm going to have a DTL column and I'm going to have a DTA column, right? So my DTL column that we have here, our total amount that we are going to get is going to be the sum of these 2 items that are going to reverse, right? This is going to be our total DTL piece here. And then what we're going to do is multiply that by the tax rate. So, actually, let me do this. I'm going to move this down. I just want to clean this a little bit easier because I like that I already put a header here. So I'm going to put the header here. I'm going to move this guy down to here, and then I'm going to apply the tax rate over to here like that. Okay, so now we'll calculate what the DTL ending balance should be. Okay, so this is our ending balance that we want. I'll move this over to here like that. Okay. So our ending balance that we have here is going to be this. Actually, let's just do this. Copy this like this. There. So here's our ending balance that we should have for the DTL. Everyone with me? And then we're going to do the DTA. So now I'm going to have this, and I'll go ahead Just like that. Copy this over like that. And this is the amount we should have for the DTA. Everyone with me? Okay, now our beginning balances we now need to take into consideration. I'm just going to give myself a little space. I just want the formatting to be the way I like. You don't have to do this. Doesn't affect the problem, but there we go. Okay, everyone okay? All right, so the next thing we're going to do is determine what our beginning balance is for each one of these. Let me go ahead and create a quick T account here. And then center. And we're going to call this DTL. I'm going to copy this over and do the DTA. Okay, so what we just did right here, that takes care of step number 2. Okay, now what we need to do is step number 3. Our beginning balance, they tell us no temporary differences exist at the beginning of 2018. So that means our beginning balance, which will be for the left side for DTL, is 0. Let's go ahead and create one more. So our left side is going to be 0. We want the DTL to be this. I should say right side, sorry. We want the DTL to be this. And so that means our adjustment that we're going to have here is going to be the difference between them. So it's this minus this. Okay. Okay, now we go over to the DTA. Again, no temporary differences existed at the beginning of the year. DTA is going to have more, oops, is going to have a beginning balance on the left side. So DTA beginning balance again is 0 because there was a 0 starting balance, it tells us. And then our desired ending balance is going to be this amount here, this 4,800. And so I'm going to go ahead and set this. I'm going to get rid of the negative here. Now, one thing I want to say about that is this. Remember that the DTA is a future deductible amount. So its normal balance will show up negative if you use it that way, like if you're calculating that way. But a DTA's normal balance is on the debit side. Remember, we're not using positives and negatives when we actually do journal entries. So you need to understand what it's representing. And so what this means is it's representing a future deductible amount. So it's going to have a negative piece in the calculation here. Okay, so then our adjustment is going to be the difference between these. And that will be 4,800. So now we know whether or not to debit, which is going to be for the DTA, or credit, which is going to be for the DTL, our amounts for each one of these journal entries. So I'm going to debit the DTA and I'm going to credit the DTL. And the amounts that I'm going to set are going to be for the adjustment. Like this. Everyone with me? Okay. Now what we need to do is plug the difference that we have here for our tax expense. So just to be clear, what we just did was step number 3. Now what we're going to do is plug the difference for our tax expense. So the amount that we're going to have here, we're going to take our sum of these items and subtract out our DTA here. And that's going to give us a total for the tax expense. Now, remember I told you that if you don't have permanent differences, technically you can take pre-tax accounting income and multiply by the tax rate, and you should get the amount for tax expense, but this is when you don't have permanent differences. Well, real quickly, let's just do a check figure because we don't have permanent differences in this problem. Let's take our pre-tax accounting income and multiply by the tax rate of 40%. So multiply by 0.4, and that gives us 32,000, and that's exactly what we plugged tax expense for. So we should be on the right track. Okay, so if you were doing a sort of table or something like this, it might look similar to this, right? That would be like a table if we wanted to. And you don't have to, but if we want to call this a table, there's a table. But this is the journal entry that, I'm hoping that you'll be producing out of the work from that table. Okay, I'm going to pause here. Questions on this?
Is there ever a situation where the DTLs and the DTAs like net against each other?
Yeah, so the DTLs and the DTAs technically are tied to specific assets and liability situations. So they should exist in their own rights, but effectively they are netting against one another. But they should exist in their own rights, especially when you're doing the calculation. You can group the DTLs together and you can group the DTAs together, but they exist in their own right, so to speak. But effectively they net against one another. Now, technically, and I need to check back on the book for this one. The other question becomes whether or not they're current or non-current too. Because when you think about it, the DTLs reverse over a period of time, as do the DTAs. And if they're reversing only within the current year or the next future year, then technically they would be a current liability versus a non-current liability. And so that would be another question that would have to be answered as to whether or not they net against one another. Does that make sense?
Yeah.
Okay, good question. Any other questions? Okay. This is chapter 16, problem 1. Let's go on to do a second problem. Let me close this one. Let's try the new one, which is problem 3. And then if we get more time, we'll go back to problem 2. So let's go ahead and try problem 3. I think I have that one open here. Okay. Let me give you some time to check this one out, and then we'll talk about it. You all can continue working on the problem. Just give you a couple more minutes here, but I real quickly wanted to follow up. Tori, I looked at the text to confirm real quickly the presentation just to give you more information on what you just asked. And it indicates for us that deferred tax assets and deferred tax liabilities are now actually shown as non-current. And prior to 2017, they were split between current and non-current. We now actually only show them as non-current. So just so that you know. And we are allowed to offset them against one another so you calculate them separately. Like I was saying, they exist in their own right. But you're allowed to offset them so long as they are relate to the same tax paying component of the entity. If they relate to separate tax paying components of the entity, you cannot offset them. But if they relate to the same tax paying component of the entity, you can offset them within the presentation of the financial statements, although you must calculate them separately. Does that make sense?
Yeah, it does. Thank you.
Yep. Okay, give you just another minute or two, and then we will look at this one. Okay, let's go ahead and take a quick look at this. See if we can calculate it together. So let me bring up my Excel. Okay, let's call this chapter 16, problem 3. Okay, so this one says at the end of the preceding year, it says the world industries had a deferred tax asset of 13,500,000. It says attributable to its only temporary difference of 54 million for estimated expenses. At the end of the current year, the temporary difference is 49 million. At the beginning of the year, there was no valuation account for the deferred tax asset. At year end, World Industries now estimates that it's more likely than not that 1/3 of the deferred tax asset will never be realized. It then says taxable income is 12,400,000 for the current year, and tax rate is 25% for all years. Okay, so what we're going to do is prepare our journal entries for income tax expense for the current year. So everything that would affect income tax, and we're actually going to do it in two separate journal entries. So the first journal entry that we want to do, I'm really following a similar process to what we just did over here, is we've got to calculate what our taxes payable is going to be. Taxes payable is going to be based off of taxable income. So they tell us that taxable income, we don't have to reconcile back to pre-tax accounting from pre-tax accounting income because they don't, I don't think, give us starting balance of pre-tax accounting income. So we'll just go directly from taxable income. So they tell us 12,400,000. Our tax rate, they tell us, is 25%. So we'll say 5. So our taxes payable we have here, it's going to be this times this. Okay. We'll do this, do this. Okay. So here's our taxes payable amount that we have here. That'll be our first step for our journal entry. Well, I don't know if this will be a debit or credit yet, so I'm going to go ahead and leave it out. But we know we have a taxes payable credit. This amount will be equal to this. Okay, everyone okay so far? Any questions on that? Okay, our second step, as we just mentioned right over here, our second step is calculate the ending balance in our DTAs and our DTLs. So we're gonna do that same sort of step. I'm gonna go ahead and steal this T count right here. Go down here, that right there. Back these out. Back. Okay, so they tell us that our amount that we have deferred tax asset of 13,500,000. So that was our beginning balance. $13,500,000 attributable to its only difference of 54 million for estimated expenses. At the end of the year, the temporary difference has gone down to 49 million. So essentially what they're saying is these amounts, so remember how we have future taxable amounts versus future deductible amounts. Sorry, that's for the next class. They're saying that we have a future deductible amount of 49 million, but it used to be 54 million. So part of it has reversed, is what they're saying. So what we're saying here is that our ending balance now should be our 49 million. Million times, let me get this real quickly, times our tax rate, which they tell us that the tax rate should be 25% right here. So multiply this by 0.25. So essentially what they're telling us is that the new ending balance should be 12,250,000. Now we started at 13.5. So we're going to need an adjustment to get from the beginning balance to the ending balance. And this is going to step 3. So our step 2 was to calculate the ending balance. Our third step is for us to adjust for the DTA or the DTL. So we're going to do that, take over this and move it to this side because we're going to have to take the difference here. So we're going to go from our beginning balance to our ending balance by reducing by that amount. Now notice DTA has a debit side and a credit side. And so obviously our adjustment to DTA is going to be on the credit side. So that's why we left some space here. We're going to say credit the DTA for this adjustment amount to get it to the ending balance we want. Everyone with me so far? Okay. Okay, then let's go ahead and finish off. So if we look, our final step is for us to plug our tax expense. So now we're going to plug our tax expense. So we'll go here and we'll say we'll debit tax expense. So our tax expense amount is going to be the summation of these we have here. Like that. Everyone good so far? Okay, now I said we were going to do this in 2 different journal entries because we have another journal entry that's going to impact our tax expense. That other journal entry that we're going to have deals with the valuation account. So this is a topic that we had in the hybrid asynchronous day from last class period. So the last thing that we're going to have to do is deal, and that's why I added this problem because I want to make sure you had some practice from the hybrid asynchronous day. The last piece that we're going to need to do is adjust for the valuation. They tell us that at the end of the year, this company, World Industries, now estimates that it's more likely than not that 1/3 of the deferred tax asset will never be realized. And remember, if it's not able to be realized, if that's what we think, if it's more likely than not that that won't happen, we have to reduce it by a valuation account. And so we are going to take this amount here and multiply by 1/3. To get our amount that we're going to have to reduce our deferred tax asset by. So now what we're going to do, this is going to be the allowance calculation. We're going to debit, I'm actually just going to steal this from here, debit our deferred tax expense, or excuse me, our tax expense, and we'll credit the valuation allowance to reduce this. For the amount that we have here. So the amount that we have here and here. And the reason why we're doing this is because essentially what we're doing is decreasing our deferred tax asset. So if you realize what we did here when the deferred tax asset started to reverse out, we used it up, so to speak, is that we increased tax expense here. So essentially what we're doing is reducing this deferred tax asset here. So again, it's increasing tax expense. And that's the idea here, because this valuation account, it essentially reduces the net of deferred tax asset. And when we reduce deferred tax asset, we create more tax expense. And so that would be our journal entry for rounding out this problem. Okay, I'm going to pause here. Questions? Okay, well, we just have 1 minute left in class, so I'm going to go ahead and stop sharing. I'm going to stop the